Alright guys, welcome to video number 2, how CLC filters out low quality trades. So the terms low quality and high quality are so thrown around by so many people in this industry. Before we can actually put a label on if something or if a trade is low quality or high quality, we have to understand how we can actually measure quality in the first place. So just as a general definition, quality is measured by identifying and assessing the variables that influence the probability and reliability of a given outcome. So for us, we're concerned with pinpointing the variables that influence the probability and reliability of a given outcome in the S&P 500 futures market. So the most relevant variables that are going to influence the probability of a trade, of a series of trades, of the odds of us being consistently profitable in the S&P 500 futures market are listed here. So before we get into this list, I just want to make an important note to you guys that the variables and components listed here are not intended to be exhaustive or fact-based. It's not absolute. These different theories that people make about markets, Elliott wave theory, Wyckoff theory, etc., they're just theories, and they're just interpretations, because that's all they can be. Nothing in the market is absolute, and so this list here is not intended to be absolute, simply because it cannot be. So let's get into it here. We're not going to get too in-depth to this stuff, but just to lay the framework and groundwork for a general understanding of the market variables that are influencing ES and the outcomes. Number one, we've got the performance of sector internals. So whether you guys are aware of not, the S&P 500 futures or the S&P 500 index is comprised of 11 sectors. Of those 11 sectors, one of them, the information technology sector, has a very dominant weight on the S&P 500 by market cap. That sector alone makes up about 30 to 35% of the market cap. When you add that IT sector with with tech names that are primarily tech driven, but not necessarily listed in the IT sector, you're going to get an assortment of companies that make up about 45% of ES by market cap. And so, of course, that is going to have an effect on the outcome of price movement. Number two is market breadth. So if the S&P 500 is moving up, what percentage or what number of stocks out of the 500 to 503, I believe, companies in the S&P 500 index are participating in that move? So how many of them are actually moving in that direction and supporting ES in that upside move? That will have an effect on the outcome. So number three is volatility. Volatility is the blood of all markets. Different volatile environments are going to change how ES moves and reacts to different price levels. Number four, macro news. Don't have to get into that one too much. If FOMC is tomorrow, if news is coming out in 2 minutes, obviously that is going to affect our trading. It's going to affect the probability that we take a winner or a loser if we're sitting inside of a trade during news, so on and so forth. Price relative to key structure. So where has price traded at? Where is price currently trading? And where is price moving to relative to key structure in the market? So if we look on a higher time frame analysis, have we drawn a swing low liquidity? Have we drawn a recent high or low liquidity from the previous day? Are we trading at an imbalanced supply or demand region? Are we trading within a region of low volume? Are we trading at a region of high volume? Are we trading at VWAP? Are we trading at a point of control? Are we trading at overnight low, overnight high liquidity? So on and so forth. These things, wherever price is trading at relative to key structure, is going to have a very important implication on the outcome. And it's not just where price is trading at, it's where price has traded at before and where it is moving towards. So that's a very important note there. It's not about just the present moment. We have to be considerate of things that have happened and that things that may happen. Liquidity conditions. So what is the average intraday volume? Is it lower? Is it higher? What time of day is it? Is it noon? Are we trading during the morning session? What's the thickness of the order book? So liquidity is going to have an effect on the outcome. Order flow. So whether you guys trade indicators or not, whether you've been trading order flow or not, order flow and orders coming into the market, the relationship between buying and selling is how price moves. And at the time of your entry, the buying and selling relationship is going to have an effect on the outcome. So if you're long the S&P 500, when there's a bunch of buying volume coming in, of course that's going to have a different outcome on your analysis, on your trade, opposed to entering the market long when a bunch of selling pressure is present. Overnight / Globe XPA, so this is very closely tied together with price relative to key structure. We're just looking at price activity that has occurred outside of regular trading hours. A lot of people disregard this, but it really is just as important as regular trading hours, price action. So however price is behaving overnight is going to have an important implication on the outcome of trades. And then there are some more personal or individual based execution variables that are going to affect outcomes. Wherever you place your stop loss, wherever you place your take profit level, however emotionally controlled you are before the trade, after the trade, or during the trade is going to affect the outcome, is going to affect trades that you take. And so these variables must be assessed to ensure that we are positioning ourselves to be taking high quality trades in the S&P 500 futures market. However, and the main point of this video here is that most trading systems only partially account for these variables. Most systems are only looking at, and again, quick disclaimer here, that the way in which I or you perceive or define opportunity is a subjective thing. The way that I look at opportunity is based off of this criteria. I have to be assessing this stuff, and then that will allow me to understand if the opportunity that I'm looking to take is lower quality or higher quality. There might be some people that get away and don't look at this stuff in the S&P 500 futures market and make money. If so, great, but it is to my interpretation that if you are not accounting for these variables, then you are more prone to be taking a lower quality position. So how does CLC differ from this? CLC is going to encapsulate these variables through a systematic framework that addresses them in a structured and chronological way. So we'll get into the chronology of it later on, but we use NQ to monitor tech and tech performance. The NASDAQ /NQ, in other words, is comprised of about 80% tech. It's 80% to 85%, I believe, tech driven. So we use that as a way to monitor tech performance. We use RSP to gauge overall market breadth. We use the VIX, the volatility index, to monitor shifts in volatility. We account for macro news before the market opens. We analyze price relative to key structure during the pre-market planning process, as well as the intraday session when new levels and new important information is developing. We use order flow tools to evaluate liquidity conditions and monitor real-time buying and selling pressure. So we're not looking at candlesticks, we're not looking at indicators, we're not looking at lines. Maybe those could augment an analysis, but it is mainly rooted in order flow and looking at liquidity conditions and buying and selling conditions so that we can have a organic and true understanding of the mechanics that are taking place within the market at the time of entry and just throughout the entire session. We are assessing the overnight and GlobeX price action during the pre-market plan. So that doesn't go over our head. When we get to the market, pre-market, we are always taking this information into account. That is a non-negotiable of being a CLC trader. And then there are the trader execution variables. So while the stop loss and take profit levels are defined through the CLC framework, like for example, the CLC framework will allow you to understand where to put your take profit level better. But of course that execution is ultimately going to be dependent on you and wherever you decide to put your take profit level. So it's more of an individual based variable there. And then the thing that is entirely upon you is how emotionally controlled you are. You could be a god at assessing all this information here, but if you can't control your emotions, then none of that matters. So by understanding these variables that affect price movement and the outcomes within the S&P 500, we can now have a better understanding of how to differentiate quality and low quality. We understand that most systems do not address these variables that affect price movement in the S&P 500 futures market, therefore being more prone to taking lower quality setups. And by being a CLC trader, we encapsulate and we focus on these variables, which allows us to trade with the market from a high quality perspective and filter out low quality opportunities. So that's going to do it for this one. Now we're going to move on to the third video, talking about how CLC allows you to move with the market.